We've experienced a little bit of a pullback. It was a decent pullback, about 5% in the stock market over the past couple of weeks, which is why I've been slacking on my content, admittedly, because I've been trying to buy the dip and spend as much time researching and looking into companies that I want to take advantage of, which have strong fundamentals and right now are potentially at discounted prices. So I'm sorry for not putting out the content, but here I am today. I don't think it's still late. I think there's still a lot of opportunities which I'm going to uncover, and I'll try to make some videos on them as I uncover them. So among the hardest hits was the semiconductor industry. When we take a look at the semiconductor ETFs, whether it be SOX or SMH, they're well below the all-time highs, and they are the most cyclical and volatile, so it just comes with the territory. They've had an incredible run in the past year because of outsized demand, because they're literally in everything now: phones, cars, computers, gaming, appliances, literally everything. And I think that we're going to continue to see this demand because we're right now in a super cycle for chips, and ignoring supply chain constraints, I think that the stocks still have some room to run. So when we see some dips like the one we've seen right now, I think it's a good idea to buy. Although of course there is risk in this because it's a very cyclical industry and we may be in a supply gut. But I don't think that's happening anytime soon, and I think the risk reward is worth it, which is why I'm buying the dip. Hey everyone, my name is Bill Hawk, and before I begin this video, I just wanted to say that I would appreciate it at any point in this video you receive some value to please hit the like button and subscribe because it helps me out with the YouTube algorithm. But today I want to give an additional disclaimer. So yeah, I am a nerd, but I draw the line somewhere, and that line is with semiconductors. I'm not a full-blown nerd, and I don't nerd out on chips. I don't understand how they're designed and the technology behind them and most up to date with that, because that's just not something I'm passionate about, and let's face it, I have to maintain my cool factor at some point. So the reason why I'm saying this is because this video is meant to be at a high level for us to understand chips, because it's an important piece that we need to invest in. But of course, if that's something that you go all in with, then you have to understand it at that level like a geek, which I would like to proudly say that I am not. Usually I'll proudly admit it, but in this case, I just wanted to make sure that you understand who you're getting this from. I hope that makes sense, and that doesn't stop you from watching the rest of this video and you don't leave now, because that would obviously make me cry. But in all seriousness, I just wanted to give you some context so you understand my thought process, where I'm coming from, and give you some context behind the stocks that I'm buying, which I'm going to share with you. But wait, there's more. The other thing I wanted to say was, in my analysis, I'm not assuming that we're going to be entering a period of stagflation, because that would be a macroeconomic nightmare. And of course, I don't want to assume that, because then shit will be pretty bad. But anyways, let's take a deep dive into foundries as a start. In terms of foundries, the conversation begins and pretty much ends with Taiwan Semiconductor Company, or TSMC, or Taiwan Semi for short. They're the largest and most technologically advanced foundry in the world by far. There's actually a pretty good YouTube video by a great content creator, which I'm going to link below if you're interested in knowing more about them. As you can see here, TSMC owns more than 50% of the world's foundry market share, which is huge. And Samsung is a pretty distant second with 17%. In case you haven't figured it out yet, and I'd really be scratching my head if you didn't, they're located in Taiwan. Now this represents a unique geopolitical risk for investors because of the China-Taiwan tensions. If you don't know much about the conflict there, I'm going to link something in the description below for you to learn more about that, an article, if you're interested. But basically, here's the latest tea. While the US has been accusing China of provocative military activity undermining regional peace and stability, China basically doesn't give a shit. And when a Taiwanese combat aircraft controller recently radioed one Chinese aircraft flying close to the borders, the pilot basically called him a motherfucker. As funny as it may sound, this is actually a pretty big risk. And it's so big that people aren't even pricing this in. Like, there's literally no way that China would have the balls to do this, and there's no way the US would let it happen. So this is a big risk that would literally impact the entire world, but it's not isolated to Taiwan Semi, because this is probably going to reach the entire semiconductor industry as a whole in any company that we're going to look at. So it's important to invest in one company, which I'm going to talk about later in this video, but let's get back to Taiwan Semi. In terms of fair value, TSMC has a DCF of about $130 per share. And right now at the time of this video, they're trading at about $110. So there's a 15% upside or margin of safety, which is not bad. So factoring in some compression in their valuation, I get a price target of about $125 per share, which is about a 14% upside from where we are right now. So I wouldn't call it expensive. I would say it's about fairly valued, but I'm looking for some alpha. I need it to be a little higher than 14% upside. So for me, it doesn't really make sense. And you can see that the stock has been trading about sideways for the past 6 months, which again is just that start of that valuation compression. For me, it's just something that maybe I would swing trade, but I really don't want to own this in the long term. Remember when I said the US wouldn't want to lose Taiwan Semi to China? Well, this is where their investment and support in local intel makes even more sense. So Intel is a value play with a long-term turnaround story. So if that doesn't interest you, then completely skip this part because the key word is long-term. You have to be patient with Intel. They've been struggling, but there's a turnaround story in place, which I'll get to. So their fair value per share is $70. So that's a considerable margin of safety from where we're trading today, almost 35 or 37%, which is huge. So it's worth taking a deep dive into Intel. Intel was once the king of semiconductor companies, and it's still one of the largest. It pretty much dominates the PC and server processor markets. The problem, however, is that Intel became complacent after its x86 chips. It lost its business with Apple, who developed their own M1 chips based on the ARM ecosystem, and Intel faced significant manufacturing delays that caused it to lose market share to key competitors like AMD and TSMC as well. They're far behind in technological development, which is why they weren't able to break into the smartphone market. And that's pretty concerning because the smartphone and mobile usage is actually cannibalizing PC usage. Pat Gelsinger left Intel about a decade ago, and he may be able to pull off a Steve Jobs. He's basically making the right moves to put Intel back on the map, but bears may look at this and just call it desperate moves. But I think he's the right guy. Here you can see Intel versus AMD's market share for all CPUs. And here you can see that Intel does have a significant server market share advantage, which is a great place to be given the growth in cloud computing, but you can see that AMD is actually starting to pick up some market share. Not to mention cloud computing giants like Amazon and Microsoft are actually designing their own chips, and now you combine that with Nvidia's GPUs being used to accelerate server workloads, it's a pretty concerning outlook for Intel. Intel does have, however, a detailed and ambitious roadmap to 2025. Along with better chips, it's also making a $20 billion investment in 2 new fab facilities in Arizona. This will allow it to compete directly with TSMC and build for other companies like Amazon. And the most important piece of this investment is the fact that it's going to have full backing of the US. It's almost an unfair advantage because Intel is literally the US's only hope at remaining competitive, and right now it's of national interest. Intel has also made a string of savvy acquisitions to build AI and automotive offerings, including Altura, Mobileye, Habana Labs, and Movidius. Overall, Intel has a pretty compelling turnaround story. For me personally, I don't love to invest in turnaround stories, but in the case of Intel, it's pretty compelling and I don't think it's priced in at all. At an 11 times PE, you're getting a bargain. It's a discount. So the upside can be pretty high and the downside, in my opinion, is limited, even though they're struggling. At the $44 level, there's key support, and I think that that's where we'll have some big hands buying in at any case, and that's 15% below where we are right now, so I would be prepared for that. But again, with any of these companies, you have to be prepared for a lot of downside and a lot of volatility because that's just the nature of semiconductors. In terms of upside, if Intel makes significant progress in their turnaround roadmap, then the upside can be unlimited. It's huge. But let's say they reach their all-time high of $65 and they haven't made significant progress, that's where I would exit my position because I just don't feel comfortable with the stock price being that high. The biggest threat to Intel is AMD. They're gunning for that dominant spot that Intel has been enjoying for many years in terms of PCs and server PCUs. They also have some pretty compelling GPUs, which are also used in cryptocurrency mining, but they're not as high-tech as Nvidia's. AMD is a much smaller company than both Intel and Nvidia, so its pricing power and R&D is naturally more limited. However, it's completely fabless, so it doesn't have those high overheads that Intel is right now taking on. AMD is worth a deep dive because of the immense growth opportunity here. They have a portfolio of leading edge products for notebooks, desktops, and data centers. They report their business in 2 main segments: computing and graphics, and enterprise embedded and semi-custom. As you probably would have guessed, the enterprise segment, specifically with cloud computing data centers, is probably where they can make the most impact. So after performing an analysis of revenues by segment, which are computing and graphics and enterprise embedded and semi-custom, you can see I forecasted their growth rate in each of these categories. The big one, of course, like I mentioned, was enterprise embedded and semi-custom, which has forecasted 28% compounded annual growth rate. Again, these are just my forecasts. Overall revenues, I'm expecting them to be about $26.5 billion in 2024. I think this is pretty conservative. You can call it bearish, but I think it's probably realistic. Then I take this and do my DCF analysis, which you can see here. This is available to members of my email subscribers. If you haven't already subscribed, the link is down below. I get a fair value per share of about $80. So as you can see, that's quite a bit different from what we're trading at. There's a 30% downside. which again is not comfortable. This is an expensive stock, but the growth is huge, and really if you want this kind of growth, you have to be taking some risk. The reason I'm just more comfortable with AMD taking on more risk is because of the price action, and I can see that this is going to run for a while, for the next maybe a year or two, based on semiconductor demand, which I think is going to be really high. So I will be taking on additional risk if I go in this position, and I will probably hedge it with Intel. I also just really like the chart pattern right now. As you can see, it just had a bullish breakout, so it's at least a swing trade for me. Nvidia is unarguably the king of semis and growth stocks, at least at the moment. If you own the stock in the past year, then you've enjoyed some juicy tendies. But as an investor, that doesn't mean that you should buy right now, because as you can imagine, this thing is pretty expensive. Nvidia's primary sales comes from gaming and GPUs. They are the dominant market player and way ahead of any competitor, which really is just AMD. Along with gamers, their GPUs have also been used with cryptocurrency miners. Nvidia's chips are also being used in data centers, which I mentioned, and also for AI and deep learning, and also in the automotive sector, most notably for self-driving technology. Nvidia is truly ahead of the curve in those segments like autonomous driving, for example. They're going to enjoy first movers advantage, but it's still too early to say with conviction that Nvidia is going to be the leader in those emerging markets, because there's still a lot of R&D and competitors that are going to be in the way. In terms of my analysis for Nvidia, I did the same thing which I did for AMD, which is by segment. Their two segments are graphics and compute and networking, but I also looked at specialized market revenues because this gives me an idea of their demand by actual sector. So gaming, professional visualization, data center, automotive, OEM, and other. And here's my compounded annual growth rate for each of these sectors, and you can compare this to actual market trends and reports to see if there's some accuracy behind this. But again, in terms of revenues, this is where we are, and total revenue, I'm expecting them to be about 42 billion by 2024. And you can see I'm factoring in a considerable slowdown in growth, slower than AMD, but again, this is a much larger company and it takes a lot more to move. So in terms of discounted cash flow and fair value, I got $174 per share. And you can see here simply Wall Street is at $117, so a bit higher. They're trading at 217 right now. There's a 20% downside. I factor in a bit of valuation compression, but not a lot. And I'm getting my price target about $175. So again, that's about 20% down from where we are right now. But again, like AMD, this is a risky stock, but there's obviously a little less growth here than AMD. There's a lot going on with this stock and there's a lot of hype, which makes me a bit nervous. But if we were to experience more of a pullback like the one we saw with AMD, I would definitely add to it. AMD is also a bit more diversified in terms of their product offering because they're also diversified into PCs and server CPUs. But Nvidia is diversified away from TSMC, which is a pretty big deal. As you can see from TSMC's customer share of revenues, Apple is their largest customer and AMD is second. Nvidia, however, diversified away from TSMC and more recently got into Samsung foundries, which is a good thing in my opinion. AMD is also a much smaller company, so its growth rates can be a lot larger for a longer period of time. Of course, we can't say that for sure, but it's a fair assumption. In terms of acquisitions, I'm ignoring the case for both. Nvidia has a pending acquisition of ARM, which can be huge, a big vertical integration, and for AMD, we have the Xilinx acquisition. But in my opinion, I think the Xilinx acquisition from AMD has a higher chance of being approved, so I'm also betting on that. So there you have it. For me, the investable dips right now in these key semiconductor companies were in Intel, AMD, and another company called ASML Holdings. They're basically the monopoly in lithography machines, which are basically a key part of semiconductor manufacturing. They're basically printing those transistors on the silicon. So yeah, look into that and check it out as well. I'm not going to get into it in this video. I hope you enjoyed the video. I honestly feel like it was a bit scattered given I talked about 3 or 4 different companies, but again, that's me just self-reflecting as I record. But feel free to let me know what you thought in the comments. I'd appreciate any comment. Don't forget to subscribe to my newsletter, and I hope to see you on the next one. Thank you for watching.